February 6, 2026, Bitcoin just shattered through the $61,000 floor, briefly touching 60,062 over, a price not seen since October 2024. In a single day, over 15% of its value vanished into thin air. Since reaching its peak of $126,400 just 4 months ago in October, Bitcoin has lost nearly half its value. Over $1.2 trillion in market capitalization has evaporated. This isn't just a correction. This is a complete breakdown of everything cryptocurrency promised to be. The destruction is total. Bitcoin crashed 15% in 24 hours, making this one of the steepest single-day declines since the FTX collapse in November 2022. This week alone saw a brutal 30% loss. But Bitcoin isn't suffering alone. The entire crypto ecosystem is in freefall. Ethereum plunged 33% this week. Solana crashed to $88, hitting a two-year low with a nearly 40% weekly decline. XRP fell 19% in just 24 hours. There's nowhere to hide in the crypto space. The liquidation numbers are staggering. More than $2 billion in leveraged positions were forcibly closed this week. On Saturday alone, $256 billion in cryptocurrency positions were liquidated, one of the largest single-day wipeouts on record. When you're trading with borrowed money and the market turns against you, the automatic liquidations create a death spiral. Forced selling pushes prices lower, which triggers more forced selling, which pushes prices even lower. It's a cascade that feeds on itself until there's nothing left to liquidate. Remember when Bitcoin was supposed to be digital gold? A safe haven during economic uncertainty, a hedge against inflation, an alternative currency that couldn't be manipulated by governments? Every single one of those promises is now broken. Look at what actually happened. Since Bitcoin's October 2024 peak, gold futures have surged 61%. Bitcoin, down 40% in the same time frame. When geopolitical crises erupted in Venezuela, the Middle East, and Europe, the exact moments when a safe haven should shine, Bitcoin didn't act like gold at all. It traded in lockstep with risky tech stocks, falling when they fell, rising when they rose. Deutsche Bank analyst Marian Labour captured the reality. Institutional investors are losing interest, and overall pessimism about crypto is growing. The institutional money that was supposed to bring stability and legitimacy to cryptocurrency is heading for the exits. According to CryptoQuant, institutional demand has reversed materially. U.S. Bitcoin ETFs that purchased 46,000 Bitcoins last year are now net sellers in 2026. CoinShares reports that digital asset investment products saw their second consecutive week of outflows, totaling $1.7 billion. That's not just a pause in enthusiasm. That's a complete erasure of all 2026 gains, pushing flows deep into negative territory. The smart money isn't buying the dip. The smart money is running. The severity of this crash comes down to one word: leverage. In crypto derivatives markets, traders can borrow 50 or even 100 times their initial investment. When the market goes up, these leveraged positions create massive gains. When the market goes down, they create annihilation. Here's what happened. As Bitcoin approached the psychological support level of $70,000, leveraged traders accumulated enormous long positions, betting billions that prices would go higher. When Bitcoin broke below that level, the automatic stop-loss orders triggered like dominoes. The liquidations accelerated into a cascade. Traders weren't just selling because they wanted to. They were forced out of positions automatically by their exchanges. This forced unwinding pushed prices far below where spot selling alone would have taken them. Even institutional infrastructure couldn't stop the bleeding. BlackRock's IBIT Bitcoin ETF set a volume record with approximately $10 billion in shares traded. But that volume didn't save it. The fund's price still plunged 13%, marking the second worst one-day drop since the ETF launched. When even the largest, most sophisticated financial institutions can't stabilize the market, you know something fundamental has broken. There's a bitter irony that can't be ignored. Bitcoin has now fallen below the price it traded at when Donald Trump won the 2024 election. Think about that for a moment. Trump's victory in November 2024 sparked absolute euphoria in crypto markets. He'd campaigned on removing regulations holding digital assets back. He promised a crypto-friendly administration. Bitcoin surged on those hopes. Traders bet billions that Washington would finally embrace cryptocurrency. That entire Trump bump has been completely erased. Every dollar gained on regulatory optimism is gone. And when Treasury Secretary Scott Bessent testified before the House Financial Services Committee this week, he made the government's position crystal clear. I do not have the authority to stabilize crypto markets. Translation: you're on your own. No bailout is coming. No government support will materialize. The crypto industry is facing this crisis alone. The casualties are piling up across the corporate landscape. Strategy, the company formerly known as MicroStrategy, is the poster child for corporate crypto exposure. They hold more than 713,000 bitcoins, purchased at an average price of roughly $76,000 per coin. When Bitcoin briefly traded below that cost basis, the company's entire bet went underwater. Their shares plummeted over 17% on Thursday as the market realized the scale of potential losses. Coinbase, one of America's largest crypto exchanges, saw its stock tumble. Circle, the stablecoin issuer, fell sharply. Robinhood dropped. The entire infrastructure of the crypto economy is under severe pressure. These aren't just crypto companies anymore. They're publicly traded firms with real employees, real investors, and real balance sheets that are now showing massive unrealized losses. And then there are the individual investors. Retail traders who bought near the October peak have watched half their investment disappear in just 4 months. Life savings, college funds, retirement accounts, all cut in half. The human cost of this crash extends far beyond corporate balance sheets into millions of personal financial disasters. This crypto crash isn't happening in isolation. It's unfolding against a backdrop of broader market chaos that makes everything more dangerous. U.S. tech stocks are in freefall. The State Street Technology Select Sector ETF dropped 1.8% on Thursday, marking its third consecutive losing day. Microsoft's disappointing earnings accelerated the sell-off across the entire technology sector. But here's where it gets truly alarming. Even precious metals, the traditional safe havens, are showing extreme volatility. Silver plunged 15% in a single day and is now trading almost 40% below its record high from just 1 week ago. Gold fell over 2% to $4,150. When even gold and silver are this volatile, you know something systemic is breaking. Analysts are pointing to credit stress in the technology sector and deteriorating dollar liquidity as fundamental threats to market stability. The fragile equilibrium that held global markets together is fracturing. A shock in one asset class triggers domino effects everywhere else. Michael Burry, the investor who predicted the 2008 housing crisis, wrote on his Substack that Bitcoin bulls are desperately selling their gold and silver positions to cover crypto losses. That's creating unusual volatility in precious metals markets that shouldn't exist. The contagion is spreading. Maya Vujinovic, CEO of digital assets at FG Nexus, cut through the noise. Bitcoin isn't trading on hype anymore. The story has lost a bit of that plot. It is trading on pure liquidity and capital flows. When the capital flows reverse, there's nothing to stop the fall. From a technical analysis perspective, Bitcoin has violated critical support levels that took years to establish. Crypto quant analysts note that Bitcoin broke below its 365-day moving average for the first time since March 2022. The decline of 23% in the 83 days since that breakdown is actually worse than the early 2022 bear market phase. We're in uncharted territory for this cycle. Some technical analysts point to the 200-week moving average at $58,000 as the last line of defense. This level aligns with Bitcoin's realized price, the average cost basis of all Bitcoin holders across history. If that level breaks, there's not much support until you reach the $38,000 range that Barry Bannister, chief equity strategist at Stifel, has identified as a potential bottom. Think about what that means. A 70% decline from October's peak of $126,400 would bring Bitcoin to approximately $30,000. In traditional markets, a 70% collapse would be catastrophic and take years. In crypto, history shows it's entirely possible, and it could happen in months. Not everyone is bearish, though. Some analysts see this as a generational buying opportunity. Long-term investors and new Bitcoin addresses are accumulating at current prices, viewing the crash as their chance to enter at levels they thought they'd never see again. But are they catching a falling knife, or are they positioning for the next bull run? Only time will tell. Before declaring cryptocurrency dead, history demands acknowledgement. Bitcoin has survived catastrophes before. In 2014, the Mt. Gox exchange was hacked and Bitcoin imploded. In 2018, it tumbled 74% amid fears about the explosion of fraudulent initial coin offerings. In November 2021, Bitcoin peaked at $69,000, then collapsed nearly 80% to around $15,800 by late 2022, a move that felt apocalyptic at the time. Each time, Bitcoin bounced back within a year and a half. Each time, skeptics declared it finished. Each time, they were proven wrong. The resilience of the Bitcoin network itself, the underlying blockchain technology, has never failed despite these price catastrophes. But past performance doesn't guarantee future results, and this time genuinely feels different. The institutional narrative that dominated 2024 and early 2025, the idea that big money would bring stability and maturity to crypto, is breaking down. When institutions are net sellers rather than net buyers, when ETFs show outflows instead of inflows, the fundamental dynamics change. The cavalry that was supposed to rescue crypto during crashes is instead leading the retreat. This crash forces us to confront uncomfortable questions about cryptocurrency's actual purpose. What is Bitcoin really for? It has failed as a medium of exchange. Despite years of promises, adoption for everyday payments remains minimal. You still can't buy groceries or pay rent with Bitcoin in any meaningful way. It has failed as a hedge against inflation. During periods of rising economic uncertainty and geopolitical tension, exactly when an inflation hedge should perform, Bitcoin has crashed. It has failed as digital gold. Instead of moving inversely to risk assets like gold does, Bitcoin moves in lockstep with speculative tech stocks. If Bitcoin is purely speculative, if it's just about betting that number will go up, can it sustain the massive level of investment and infrastructure that's been built around it? Can it justify the enormous energy consumption of Bitcoin mining? Can it support an entire industry of exchanges, custodians, and service providers? The broader crypto ecosystem faces similar existential questions. Blockchain technology has legitimate applications. Tokenization of real-world assets could revolutionize how we handle property titles, securities, and commodities. Stablecoins are facilitating cross-border payments more efficiently than traditional banking. Smart contracts are automating complex financial operations. But if confidence in cryptocurrency collapses entirely, does it take these innovations down too? Does the baby get thrown out with the bathwater? The systemic risks extend beyond crypto enthusiasts. Bitcoin is now embedded in investment portfolios held by pension funds, endowments, and family offices. It sits on corporate balance sheets. El Salvador made Bitcoin legal tender and holds it as a strategic reserve. If the price continues to crater, the damage spreads into mainstream financial institutions. We're already seeing early warning signs. Crypto-focused venture capital funds are facing redemption requests they can't meet because their assets have lost so much value. Crypto lending platforms that survived previous crashes are now showing signs of stress. Mining companies that invested billions in equipment are operating at losses and cutting operations. The interconnectedness means a crisis in crypto can impact credit markets, corporate debt, and even banking stability if exposure is concentrated in the wrong places. Regulators are watching carefully, but they've also made clear they won't step in to save the market. Despite the carnage, some long-term positives remain for those willing to look past the current crisis. The Clarity Act expected to pass in 2026 could provide regulatory clarity for digital commodities, potentially attracting new institutional investors once the dust settles. The shift toward regulated stablecoins and tokenized assets continues regardless of Bitcoin's price. Stablecoins have grown from $310 billion to over $500 billion, expanding for 25 consecutive months. They're transitioning from experimental tools to core components of institutional finance, facilitating billions in daily transactions. This growth continues even as speculative cryptocurrencies collapse. Real-world asset tokenization is expanding. Major financial institutions are exploring blockchain-based securities settlement. The infrastructure is improving. Exchanges are implementing stricter risk controls, custody solutions are becoming more robust, compliance frameworks are maturing. But the reality for 2026 is clear. This won't be a year of hype or memes or get-rich-quick promises. This will be a year of consolidation, compliance, and institutional money driven by fundamentals rather than speculation. Tokens that survive will be those with clear use cases, sustainable revenue models, and genuine utility, not just marketing narratives and viral momentum. The survivors will emerge stronger. The casualties will be forgotten. That's how markets work. For investors trapped in this storm, financial advisors offer straightforward guidance. First, be brutally honest with yourself. If you bought Bitcoin at a higher price than it trades at now, ask yourself one simple question. Would I buy Bitcoin today at this price? If the answer is no, you should probably sell. Holding on to losers out of hope isn't investing, it's wishful thinking. Second, consider tax loss harvesting. If you sell Bitcoin at a loss, you can use those losses to offset gains from other investments, reducing your tax bill. Unlike stocks, cryptocurrency isn't currently subject to the wash sale rule in most jurisdictions. So you could theoretically sell, realize the loss for tax purposes, and rebuy immediately if you still believe in the long-term story. Third, remember the cardinal rule that should govern all crypto investing. Never allocate more than 5% of your portfolio to cryptocurrency. The extreme volatility we're witnessing now is exactly why that rule exists. If you're feeling sick to your stomach watching your portfolio, you allocated too much. Fourth, understand that crypto winters don't end with excitement. They end with exhaustion. Markets need to completely flush out the speculation before they can rebuild. Good news about institutional adoption or regulatory clarity won't immediately spark rallies. First comes capitulation, then comes boredom, then comes slow accumulation, and only after all that comes the next bull market. Bitcoin sits at approximately $62,000 as of this recording, having briefly crashed below $61,000. It has lost nearly half its value from the October peak. Over $1.2 trillion in market capitalization has evaporated. Institutional investors are net sellers. Retail confidence is shattered. The digital gold narrative lies in ruins. Yet Bitcoin's greatest strength has always been its capacity to survive. It has endured hacks, regulatory crackdowns, competing cryptocurrencies, corporate fraud, and multiple 70% plus crashes. Each time, it has returned. The blockchain continues operating. The network continues processing transactions. The technology endures even when the price collapses. The question moving forward isn't whether Bitcoin will survive this crash. It almost certainly will. The question is what role it will play in the financial system going forward. Will it fulfill the revolutionary promise that early adopters envisioned? Will it become digital gold for a new generation? Or will it settle into being just another speculative asset class, volatile, risky, and suitable only for those with strong stomachs and money they can afford to lose? What we're witnessing isn't just a price crash, it's a reckoning with reality. The gap between cryptocurrency's grand promises and its actual performance has never been wider. The marketing has outpaced the fundamentals by such a distance that the market is now violently correcting the imbalance. For true believers, this is their buying opportunity, a chance to accumulate before the next cycle begins. For skeptics, this is validation, proof that crypto was always too good to be true. For the majority caught in the middle, it's a painful lesson about speculation, leverage, and the eternal truth that gravity always wins eventually. The crash of February 2026 will be remembered as the moment when cryptocurrency's soaring promises collided head-on with cold, hard economic reality. What emerges from the wreckage will determine whether blockchain technology revolutionizes global finance or becomes a cautionary tale studied in business schools for generations. Until then, the only certainty in crypto is volatility, and right now, that volatility is pointing straight down.